You walk into your favorite coffee shop to get yourself a latte with a signature shot of espresso and an everything bagel. You place your order and tap your card on the payment screen. You hear a beep and see the words payment approved on the screen in green. The cashier then hands you your receipt and you wait for your order. Once your order is ready, it is handed to you and you leave to continue your day. Later in the month, you receive a letter in the mail from your bank with the title Credit Bill and wonder what to do next. This video will be going over the process of a credit card and the rudimentary understanding of a credit score. What is a debit card? A debit card is a card associated with your checking account that is open with the bank. The account is filled with money that you add via deposits or payroll payments. The money is placed there by you and is in your name completely. The money spent will be taken out of the account and transferred to the institution you are paying, such as the coffee shop for the purchase of the coffee and food. What is a credit card? A credit card is a card given to you by the bank at which you applied to open a credit account. The money associated with the credit account is borrowed money from the bank with an agreement that you will pay the bank back the money you used, and if the payments are missed, you will pay the interest associated with the payment. Therefore, the coffee shop asked the bank if the bank would pay for the coffee and the food. The bank agreed and added the payment to your credit card for you to pay the bank back later. A credit card bill or statement is the money that was used through the credit account over a 30-day billing cycle. This statement will tell you how much you spent, how much you owe, and how much is on your credit line, how much you're allowed to use within the next 30 days. If you pay the full amount of the money you spent back to the bank, there will be no interest. For example, if you used $100 in credit and at the end of the month you paid all $100 back, then the balance would be zero. However, if the minimum payment allowed is $25, you will only pay the $25, then the remaining balance will be $75 plus the interest to the next month. A formula would be interest equals the average daily balance times daily percent rate times the number of days. Let's break this down. First, let's say the bank and you agreed to a 24% interest rate, but that is for the year, and we need to break it down into the daily decimal amount. So we will do 0.24 divided by 365, which equals 0.0006575. So if the balance left is $75 and the daily percent rate is 0.006575, and there are 30 days in the billing cycle, then the answer would be 17.9990625. Therefore, $18 would be owed and added to the $75, equaling $93 owed next billing cycle. The amount will go up also if you use your credit card, and then the interest will be added onto the daily new balance. Let's say your due date is the 25th of the month and the closing date is the 29th. The amount due should be paid by the 25th, but if you pay any time before the 29th, there will be no penalty. However, if you pay on the 29th or maybe the 31st, the payment will not be processed in time and will be counted as not paid. After the pay period, there is a pause while payments are processing. Let's say you can't use your card till the 4th of the month. If you purchase anything on the 2nd, then that will go onto last month's bill and not be paid and counted as a missed payment. Now that we have a basic understanding of a credit card, let's do a quick once-over of a credit score. This is just going to be a quick look at a credit score. If you would like a more in-depth explanation of a credit score, leave a comment down below. A credit score is a 3-digit number that represents how trustworthy of a borrower you are and how consistent you are at paying off your debts off in a timely manner. This is what banks look at to see if they will lend you money for, let's say, a car loan, mortgage payment, and approval for bigger credit card companies, and affects the interest rates and payment options banks are willing to give you. This is the usual rating system. Excellent is the range of 800 to 850, which means very low risk. Very good is the range of 740 to 799, which means low risk. Good is 670 to 739, acceptable credit. Fair is 580 to 669, some risk. Poor is 300 to 579, high risk. There are several things that take a percentage of your credit score and how much they add or hurt to your score. Generally, payment history is 35%. Paying bills on time will build, while late or missed payments will hurt your score. Credit utilization 30%. How much you have available in your credit and how much of that limit you use a month. A general rule is to try and use less than 30% of your credit limit a month. Length of credit history, that's about 15%. How long you've had an open credit account, such as loans or credit cards. New credit slash inquiries, around 10%. Trying to open many credit card accounts puts an inquiry on your account and looks like you have to go scrapping for cash a little too much. Credit mix is about 10%. Having a variety of credit card accounts and loans makes you look good at managing your finances. All in all, the sooner you open a credit card, the better to build a credit history, but you must manage your money appropriately. Keeping track of due dates and no use dates on your credit card and try to stay below 30% of your credit limit and pay your full bill every month. An idea would be to use your credit card for coffee or small meals that you already have the money on hand for, but instead use your credit card and pay the credit account right away so as to use your credit account without putting yourself in a hole. Thank you for joining me in this lookout over credit cards. Until next time, bye.